The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Happy Friday, everyone, and welcome to Squawk Box. I'm Karen Cho, and these are your headlines today. Apple shares sour in extended trade on cautious guidance for the key holiday season, while the tech giant gives little clarity on demand for its latest iPhone. Amazon shares jump in after hours as the e-commerce giant posts a beat on quarterly earnings and revenue, with the CEO Andy Jassy vowing to spend big on developing the company's AI capabilities.
It is a really unusually large, maybe once-in-a-lifetime type of opportunity. And I think our customers, the business, and our shareholders will feel good about this long term, that we're aggressively pursuing it.
US tech majors turned red on disappointing results as the S&P 500 and the Nasdaq suffered their worst day in over a month. And a sell-off in gilts ramps up, while sterling sees volatile trade amid concerns the UK Chancellor's budget will reignite inflation while piling up debt. Good morning. Big moves in technology stocks and after hours as show and tell season rolling on across the course of the trading week. And Amazon, the one the market focused on, as shares popped in extended trade after the e-commerce giant posted a beat on third quarter sales and profit and says it expects to see strong results going into its key holiday quarter. But investor attention was focused on its cloud business, AWS, which saw revenue grow 19% to over $27 billion. You'd think that'd be enough, but the whisper number a little bit stronger than that on the street before the earnings had hit. Now, on artificial intelligence, the CEO Andy Jassy said the company plans to, quote, aggressively ramp up CapEx to $75 billion for the full year, the bulk of which will go towards generative AI. Amazon CEO Andy Jassy discussed how generative AI can improve Amazon's Alexa.
The next generation of these assistants and the generative AI applications will be better at not just answering questions and summarizing, indexing, and aggregating data, but also taking actions. And you can imagine us being pretty good at that with Alexa.
Apple shares, though, are trading in the red in after hours. This after the tech giant gave lackluster revenue guidance for the coming quarter, raising questions over its sales momentum going into the holiday season. Nonetheless, the company posted a quarterly net income of just over $15 billion, while revenue came in at just under $95 billion, both beating estimates, although that factors in a one-off tax charge from the EU. On the call, CEO Tim Cook said sales of the new iPhone 16, which comes loaded with new AI features, have gotten off to a strong start. However, only about a week of new device sales overlap with Apple's latest fiscal quarter. Let's get to Shana Sissel, who is the CEO and founder of Banyan Capital Management. Shana, thank you very much for joining us. Apple, after hours, interesting moves to the downside. The market looking at the lack of clarity here. What did you make of what we heard from Apple?
Well, I was encouraged by the fact that they are having better than expected iPhone sales. iPhones are 49% of all the sales that they do, so it's a huge part of the revenue that they generate. I was more concerned with the fact that it's becoming more and more about just the iPhone for them. If you looked at the entirety of their revenue and where it was being driven from, they missed the estimates and all the other categories. So for me, that's concerning. But the one thing that the market was really paying attention to and really wanted to see was increased sales. This was a record iPhone sales report. They want to see this upgrade cycle actually take hold, and they want to see if people are interested and driving into the Apple Intelligence technology that is going to be rolled out. And it looks like all of those things are happening.
Shana, no doubt a lot of hype around Apple Intelligence, but just what are people getting? If they buy the new iPhone today, are they getting the full capabilities? Or is that part of the issue that a lot of people are waiting it out? They're waiting to see what the benefits are when you truly have a full-blown launch of this new technology?
Well, they haven't rolled out the full capabilities of Apple Intelligence yet. They've done some very basic rollout with 18 iOS 18.1. And they've seen people adopt the new operating system much quicker than in the past. I think he said on the call 2 times faster than they've typically seen the upgrade of the operating operating service. But I will say this. If the concern is, and the market wants to see, if people are waiting on the sidelines to buy the new iPhone to see what the technology is coming out, we're already seeing better iPhone sales on the 16 and even on the 15 as a result of just the idea of Apple Intelligence. So if we're already seeing a watered down version of it drive sales, when the newer version comes out, I think that's encouraging. I think that suggests that momentum will pick up.
Sean, a good point. And of course, as people talk to friends and tell them what the capabilities are, perhaps there's more of a hype cycle to come. I want to just move on to China because we are seeing more competition on the ground. And it felt as though Huawei was very much on the back foot after some of the big issues around access to chip technology on the back of first the Trump administration, that continuing through with the Biden administration. But now when it comes to China, Huawei seems to be back in some form. What impact is that having on the ground in China?
Well, it certainly impacts Apple quite a bit. If you looked, again, through their earnings and you looked at some of the nuance, the expected revenue out of China was about $15.8 billion, and they only generated $15 billion, which, that's still a big number, but it's $800 million off what the expectations were because Huawei is picking up steam. And that is concerning because if you think about it, Apple's kind of saturated the market here in the United States. It has a pretty good market share in Europe. And as you think about where the growth opportunities lie for Apple, it really is in Asia and specifically China. And if they can't ramp up there, and if they're facing too much competition, the competition's, more than exceeding what the expectations are, that's troubling for future growth opportunity for Apple.
The timing of the earnings coming on the back of a real product refresh too, beyond the iPhone. And we saw what the iMac, the Mac Mini, the MacBook Pro all refreshed over the course of the week. But obviously too early to tell what the sales look like. What do you make of what could come in following quarters thanks to that refresh? Does it take some of the heat off iPhones to be the heavy lifter here?
I'm not sure it does. I think what Apple's really missing is the innovation it once had. A refresh is just that, a refresh. Is it enough to encourage folks to go out and buy brand new product from Apple because of the refresh? And we've seen, even with the iPhone, that isn't always the case unless there's something drastically different. Apple hasn't really brought a new product to market in a while. The last really big differentiated product Apple brought to the market was the Apple Watch. And Apple has basically grown and built its reputation on being innovative and bringing products to the market that people didn't even know they needed. And so, yeah, refreshes are great, but it's just that it's not new innovation. And I'd like to see Apple have some new innovation. I think the company needs that in order to stay ahead and to continue to grow the business. But as it stands right now, I don't see any of the refreshes of the products really driving any additional growth or sales outside of just the people who would normally refresh because things get old.
Can I ask you how Apple now sits amongst its peers? Because it's been a big week as we've seen a lot of the big rivals produce numbers. But the big message was really, look, AI spend is going to get even deeper from here for the hyperscalers, the likes of Microsoft, Meta and Alphabet. Does it now look as though Apple might be a safer play without some of the big capital expenditure that is now required to build out AI? How do you think about Apple in that context?
Well, I do think that is an advantage for Apple. I think that as it stands, the key to success in AI right now is being able to monetize it. And, we saw in the Alphabet earnings that they are finding ways to monetize the AI tools that they're using. That is a good thing. But Apple is able to monetize it through this upgrade cycle with the iPhone. And I think that that's a positive. I think overall, to take a step back from Apple, what this really I find encouraging about this is what it means for NVIDIA. NVIDIA has kind of driven the US stock market here. It's really been the leader. As NVIDIA goes, so goes the market. And what we've seen in all of the recent reports, whether it be Meta or Microsoft or Alphabet or Apple, is that AI is here to stay, and it is the wave of the future. And these companies are committing a lot of capital to continuing to build out their AI tools. And it's encouraging to see that it's being monetized, because there's got to be a point where, do you keep throwing money at something that you can't make money with? So seeing these signs means that it is being monetized, which is bullish for future and growing adoption and more capital spend in AI, which is positive for an NVIDIA.
What did you make of the likes of Amazon as well after hours? Because it was the only one really to pop in extended trade in the market. I think looking at the numbers, AWS a little bit disappointing, but they were pretty impressed with the retail numbers, which has been quite a stretch for this business that they've been building out over the years. AWS has really been doing the lion's share of some of that heavy lifting for the company. But was there much in the Amazon numbers for you?
Well, like you said, seeing the retail side kind of rebound a bit and have driven more of the earnings than it normally does is positive. It's the exact opposite of my concern with Apple, right? So Apple, my concern is it's becoming too dependent on one product, and that's always a recipe for disaster. That's risky. And Amazon, with AWS, was kind of seeing the same thing, but with a broadening of the revenue coming from other areas. That is largely bullish for the stock, because, you're not as dependent on a single channel. And so that's why I think that stock popped after hours.
And Shana, thank you so much for joining us today. I was just looking at the disclosures that you do own the stock when it comes to Apple as well. We do appreciate you digging into the detail for us. Shana Sissa with us, the CEO and founder, Banrian Capital Management. Intel shares surged nearly 7% in after-hours trade as the company posted an expected adjusted profit after excluding a large impairment charge and several other items. The chipmaker posted an overall net loss, though, of just under $17 billion. That factors in nearly $3 billion in restructuring charges and a further $16 billion in impairments on equipment and goodwill write-downs. When revised, that gives Intel an adjusted profit of 17 cents per share. Speaking to CNBC, the CEO, Pat Gelsinger, said the company is building towards the future and looking to compete with other big chip names.
We feel like we're set up well, for the future. That's why we've taken these hard restructuring steps. We're also taking, the steps to make sure we have the balance sheet and the capital capacity, the capital efficiency to complete the journey, right? Both getting Intel back to product leadership, process leadership, launch us as a foundry, and really establish this role that Intel uniquely plays in the technology industry in the US and in the global supply chains of the world.
OpenAI has announced the launch of a search feature within its AI chatbot, ChatGPT, better positioning the company to compete with the likes of Alphabet and Microsoft. The firm said the search feature is powered by partnerships with news and data providers, along with real-time web search, offering the likes of live news and sports scores. And of course, we're going to be watching this closely to see what it does to the Google moat. Ahead on the show, gilt selling off and sterling whipsaws as concerns over the UK budget continue to reverberate through markets. Plus, Kamala Harris and Donald Trump on the offensive in key battleground states in the final sprint to Election Day. We'll have more later this hour. And Greek bank Piraeus is set to report its latest numbers. Don't miss our interview with the CEO at 8:30 GMT. It has been an interesting trading week, and I want to get into that a little bit with Sylvia, because earlier this week we were sitting on still some week-to-date gains. Yesterday it felt like we gave it all back, and I wonder whether this is just some caution ahead of next week, which we know is a monster week with the US election and also a potential rate cut from the Fed.
Totally. And then let's not forget that this was the busiest week for earnings stateside as well. And overall, it just hasn't been a good month for U.S. equities. But let me run you through what happened yesterday on Wall Street. We saw a lower trading session over there with a heavy focus on the tech sector. We saw, for instance, the Nasdaq, and you have the numbers on your screen, finishing today down 2.76%. This amid several tech earnings. And overall, just to give you an idea, the tech sector was down 3.6%. I want to take you to what we also saw in terms of the treasury market, because naturally, we obtained very important data yesterday, including new PCE figures, and this has an impact in terms of how investors are feeling about what the Fed is going to do next week. Now, we have seen Treasury yields moving to a 3-month high. Let's see what we'll get later on today, because let's not forget, today, perhaps the most important piece of economic data, we're going to see the latest non-farm payroll figures. Let's see whether that's going to change any expectations regarding potential rate cuts from the Fed. I also want to take you to the currency space. We know that in recent times there's been quite a lot of talk in terms of the strength of the dollar. That has dissipated a little bit during yesterday's session. We actually had the dollar index down just marginally below the flat line, really. But it's on the sterling that I want to focus at this stage. Sterling has been under a lot of pressure amid these concerns regarding the fiscal position of the United Kingdom, with investors at this stage questioning really whether we're going to see higher rates for longer in the UK. Just briefly looking at the Japanese yen, it actually rose 1% overnight. So a bit of a change in the narrative when you think about the Japanese yen in recent days. But of course, when we heard from the Bank of Japan yesterday, they still kept the door open to potential rate hikes in December. When it comes to the commodity space, this is what we have seen recently. I actually want to take you to gold, because the story around gold has been the strength they has reported in recent times. However, yesterday it fell 1.84%. So a bit of relief here when it comes to some of the purchases of gold. All in all, though, month to date, 3.38% up. And briefly looking at oil prices, we are seeing oil prices moving slightly higher at this stage. This after we saw them falling significantly at the start of the week. When you think about what has happened in European equities, what a month, really. We have seen actually the weakest performance for the Stoxx 600 in over a year. At the end of the month, we had the Stoxx 600 down 3.35%. Let's see what we'll get later on today. But of course, no doubt that the changes in monetary policy expectations and the earnings releases have had an implication in how we have seen the Stoxx 600 faring. When it comes to the performance in Asia thus far today, the first trading day of November, it seems to be a bit of a mixed picture. We have the Nikkei 225 trading lower as we are witnessing more strength in the Japanese yen and a little bit of relief when it comes to some of those Chinese equities after we got data earlier this morning suggesting the factory outputs actually expanded in the month of October.
Sylvia, thank you. Let's just drill a little bit deeper into that gilt story, because gilts are continuing to sell off in the aftermath of Rachel Reeves' budget announcement, which the head of the country's budget watchdog called one of the largest fiscal loosenings of any fiscal event in recent decades. Investors are grappling with a 1-2 punch amid the Debt Management Office announcing one of the biggest gilt issuances on record and warnings that government policy could boost inflation. Sylvia, it is a spike. Relative over the last 5 years, it's not as big a spike as what we've seen previously. Yeah. And of course, there's the trust moment that I'm talking about. But what it does constitute a £28 billion increase in borrowing. That is something that I think when you talk about cycles, the cycle has been very welcoming in recent years, but I wonder where that's just starting to turn now. And the debt issues are cropping up more and more. So I wonder what the debt markets are now telling us about this.
Whether investors are perhaps waking up a little bit more to some of the debt dynamics. There's a lot happening here. And yesterday we were discussing how it felt the investors were still trying to understand every little piece of the details that Chancellor Rachel Reeves announced. Ultimately, the performance we saw yesterday in terms of the bond market show concerns that we might see higher rates for longer in the United Kingdom. Just to give you an idea, the Office for Budget Responsibility, after the budget, has said the British inflation is set to average 2.6% next year. That's above the 1.5% that was initially forecast. So we are seeing a huge increase here in terms of inflation expectations for 2025. And of course, that could have ramifications for how the Bank of England conducts monetary policy. We know that this move in the bond market yesterday actually allowed the Chancellor to feel the need that she needed to come and address some of the concerns in the market. So I just want to refer some of the comments that she made yesterday. She very much stressed that her number one commitment and of the new Labour government is economic and fiscal stability. Whether these commitments, Karen, and these statements are likely to offer any sort of relief to bond investors out there remains to be seen when the markets open later on today. But more broadly, it seems that initially she was striking the right tone between having more spending, having a Labour budget, and not concerning the markets. However, that has gone now, and it's very clear that bond investors out there are keeping a very close eye on what this government is going to do.
It's all very well to have revenue-raising measures, but if they're not practical and they don't yield results, then what was the point of them in the first place? And I think the OBR numbers suggesting some of the revenue will not be attained does just pose some threat, doesn't it, to borrowing for next year?
And that GDP expectation is just not there. When you look at the comments from the OBR, from the Institute for Fiscal Studies, they are struggling to see how this budget is going to lead to any growth of 2.5% over the coming years. So for the question mark is, why are you spending, why are you borrowing so much if we're not seeing then the economic growth that you're promising us?
The big hand of the government, because the government knows best. I think that's usually the theory, isn't it? Sylvia, thank you very much for that. Manufacturing activity in China returned to expansion in October. Caixin PMI data showed, echoing Thursday's official data, which pointed to the first expansion since April. Manufacturing PMI from the private survey came in at 50.3, topping forecasts. Sam Vadas filed this report.
More encouraging data out of China today. A private gauge of factory activity jumping back into expansion. The latest survey looks at the smaller manufacturers in China, but was consistent with the official data, which focuses on bigger and state-owned firms, which leaped out of contraction for the first time in 6 months. New orders grew, which helped output improve at the fastest pace in months, while business optimism about future production was at the highest since the first half. Input and output prices also rose slightly, but it wasn't all rosy. New export orders contracted for a third month, and factories shed workers at the fastest pace since May last year. In perhaps another encouraging sign, though, another private survey on property showed new home prices picking up last month. October is traditionally known for peak housing demand in China, but after a few years of losing its shine, we're starting to see some early signs of confidence coming back. Now, Chinese stocks wobbled in the morning session. The yuan also pulling back against the dollar. Investors are now awaiting more details of a potential fiscal package to further support the economy, many hoping the size of that will come out at next week's top brass meeting here in Beijing. Reports suggest the government is weighing new debt issuance of more than 10 trillion yuan in the coming years. Sam Varda, CNBC Business News, Beijing.
Let's take a look at Japan, and we've seen some declines in the Japanese stock market today. We're down 2.6%, but we have ticked higher when it comes to dollar-yen rates today, a bit of a bounce of about 1/3%. What we're seeing here, factory activity in Japan slowed at the fastest pace in 3 months, falling to 49.2 in October. It comes as weak domestic and overseas demand hit sales and output, according to a private sector survey. The IMF has also warned that the country must fund new spending with current funds rather than issuing further debt, as Prime Minister Ishiba pledges a new spending package to protect households from rising prices. The Bank of Japan has warned that a hike in the minimum wage will increase the odds of a spike in consumer prices. The country's average minimum wage is set to grow by a record 5.1% in the fiscal year through to the end of March 2025. The BOJ said the move is to see services prices rise as a result. Speaking to CNBC in an exclusive interview, the chairman and CEO of Fast Retailing said wage stagnation in Japan is almost at a crisis point.
Well, 5% is, from my perspective, absolutely out of the question. Because if you look at the past exchange rate, it used to be 80 yen per dollar. It's hiked to 160 yen per dollar. It's around 150 yen now. That means it's almost half off. And what we are, fortunately or unfortunately, all the transactions are settled in dollars. But if you look at other advanced markets and developing cities in some of the agencies, you tend to see that our country is getting caught up. Therefore, at least we need to double the wage. Otherwise, Japanese people are not able to catch up with the other nations, people's living standards. Another point I wanted to say is that for the past 30 years, Japan has been in a dormant stage. In other words, no wage increases during 30 years whatsoever. If you look at the reality, it's almost like it's been coming down, reducing the actual paycheck. And this is like almost a crisis situation. Surrounding nations have grown significantly, inclusive of the United States. So what other words than crisis can you say in this situation?
Indeed, and I know that last year, in 2023, Fast Retailing had announced up to, I believe, 40% wage increases, right? How has that impacted productivity and staff retention, just quickly?
It was a tremendous plus for us. Well, remember, this is not what's called the base increase of all of the paycheck. We evaluated each one of the associated managers, and what we offered is a maximum raise of 40%. It's not a flat 40% increase for everyone. So we carefully evaluated everyone and tried to provide hand-picked promotion, well-planned promotion, or even demotion. And from my perspective, the lifetime employment system, any formal pay raise is not a good practice. Japanese companies need to evaluate what is this person's deliverable and this person's potential value and potential contribution to the company. Based upon that, they need to evaluate how much they would be paying this person and try to organize their company based upon the select few, as opposed to being totally dependent on the very labor-intensive ways of working. Otherwise, everyone would go bankrupt.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.